Well, hello everyone, and welcome to today's webinar, the first on active and passive management by the Fry Group, and a great privilege to have so many of you join us for it. Just by way of an introduction, my name is Charlie Buxton, and I'm a portfolio manager here at the Fry Group. I'm based out of our Hong Kong office. So just a little bit about how we're going to run today's webinar. I will shortly be providing a very brief overview as to what active and what passive investing is and what it means to you as an investor. I will then be introducing our two keynote speakers for the day. That's Cappetta of 91 Asset Management and Georgina Mitchell of iShares BlackRock. Now after that, we'll go into around about a half an hour discussion around some of the key themes about the topic. And after that, we'll have a Q&A with you, the audience. So please do use the Q&A box to the bottom of your screens to ask any questions that you might have. Once we're done with that, I'll then wrap things up and give a very brief overview as to the Fry Group, who we are and what we do. So just a little bit about active and passive investing, what it is and what it means to you as an investor. The key point with active management is where a fund manager or a team of fund managers are looking to outperform a benchmark, or what's otherwise known as an index. So for example, if you are a global equity fund manager, it might be that the index or the benchmark that you're looking to outperform is the MSCI All World. And what you're looking to do is to generate a level of excess return to that of the index. So for example, with the MSCI All World, this is an index comprising largely large and mid-cap stocks. And the idea is for the fund manager or the team of fund managers to pick stocks using both qualitative and quantitative analysis that they deem likely to outperform over the longer term. Now compare and contrast this with passive management, where the idea of the management team here is to merely mimic the same returns to that of an index. And I should say that passive investing is also known as index investing. So to give you an example of that, if you're looking for exposure or pure exposure to just the S&P 500 via a passive strategy, it might be that the management team there buy up all 500 constituents of the index merely to replicate exactly the same performance of the S&P 500. So here, the management team are merely looking to deliver exactly the same returns to that of the S&P 500, whereas an active manager or fund manager will be looking to deliver returns in excess of the benchmark, or what's otherwise known as delivering alpha. So just to give you a bit of an idea as to the popularity of exchange traded funds, which is a type of passive strategy over the last 10 years, you'll see that at the start of 2011, there was a little over $1 trillion under management. In other words, a little over $1 trillion in passive strategies. Now, over the course of those 10 years, and as at August this year, that figure has grown almost fivefold to a little over $5 trillion as at August this year. So a clear upward trajectory in the popularity of passive strategies. And to help us shed some more light on that, I am delighted to welcome both John and Georgie. John is from 91 Asset Management and Georgie from iShares BlackRock. Thank you both for joining us. I'm going to stop sharing my screen. Georgie, perhaps let's start with you. If you could just give us a very brief introduction as to who you are and what brings you here today.
Of course. Thank you, Charlie. Can you hear me okay?
Yeah, that's fine. Thanks, Georgie.
Welcome, everyone. Thank you for joining us this evening or this afternoon, depending on your time zone. My name is Georgina Mitchell, and as Charlie mentioned, I cover iShares distribution for wealth clients in Asia. So for a bit of background, iShares is the exchange traded fund business within BlackRock, and we manage about $2.3 trillion of ETF assets globally. And to add to what Charlie said about ETFs, or exchange traded funds, ETF stands for exchange traded funds, and ETFs are just like a mutual fund or just like an active fund, but they trade on a stock exchange. However, instead of, as Charlie mentioned, active funds stock picking and trying to outperform the market, ETFs typically track indices like FTSE 100 in the UK or S&P 500 in the US, which are examples of large cap stock markets. But we can also have ETFs that invest in specific countries or in fixed income markets or thematic ideas like robotics and climate change, etc. So just like you can have an active fund that invests in pretty much anything, the same is said for ETFs. The product range globally is huge, and we've managed to sort of replicate a lot of indices using ETFs across the globe. In my role, I manage relationships with wealth clients spanning from the largest global private banks in Asia down to smaller robo-advisors and financial advisors. I have been in Asia for 3 years and have been working with BlackRock for that whole time. And before that, I was with BlackRock in London, also covering wealth clients across the UK, distributing our ETF products. So thank you very much for having me today, Charlie. And it's great to be here with John as well.
That's great. Thanks, Georgie. That's perfect. And John, same for you. If you could just give a brief sort of introduction on yourself and what brings you here today.
Absolutely. Thank you, Charlie. Pleasure to be here. I'll keep it short. My name is John Cappetta. Work with 91. Some of you might be familiar with our name prior to us becoming 91. 91, we used to be Investec Asset Management. Investec Asset Management was formed back in 1991. Hence this very simple name change from Investec Asset Management to 91. As a firm, we're very proud of when we were created back in that year. I look after Asia advisors in terms of the private banking channel for 91. 91, we are active mutual fund managers offering a range of products across equity funds, fixed income funds, multi-asset, as well as commodities, natural resources. Next year is going to be my 30th year in the industry, and I am based in Singapore, and I have been working and living in Asia for a combined 15 years. So it's a pleasure to be here, and hopefully we could share some good insight and knowledge with your clients, Charlie.
That's great. Thanks, John. And thank you both. Great to have you here with us today. John, we'll stick with you. Let's talk about this year, which has been a particularly turbulent year for markets. If we think back to mid-March, when we saw some extremely volatile moves, some record lows in equity markets, which have since recovered as we stand here today. In this kind of environment where you've got very supportive monetary and fiscal policy, how easy is it for active fund managers to exploit price inefficiencies in these kind of market conditions?
Thanks, Charlie. Active mutual fund managers, we can exploit inefficiencies, but active mutual fund managers, we're asking our investors to keep their eye on the longer term prize. When investors come in to actively manage mutual funds, we typically want them to have a time frame of 3 to 5 years. When it comes to investing, when it comes to being successful investors, time in the market, not timing the market, is your friend, to be patient. But, as you mentioned, you go back to earlier this year. But now, if you look back on it, it actually almost feels like a flash crash. It was so quick from peak to trough to the recovery. But that's an excellent opportunity for mutual fund managers to go in there, look through the debris of what happened, and try and find those gems that were, lack of a better term, what normally happens in this type of environment. A lot of babies get thrown out with the bathwater, because clients, institutional investors, the pullback happened so quickly, they became forced sellers. Whether they got spooked off the market, we didn't know what was going to happen. A lot of people were getting margin calls, so they had to unwind positions. And when you're trying to unwind positions that you hold in a very challenging market environment, there's going to be bargains out there. It's unfortunate for the seller, but it's a great opportunity for the buyer. And when you're long-term investors like active mutual funds, those are the opportunities where we're not trying to make a quick profit, Charlie, but we're going to pick up some of these names that were, oversold for no particular reason, just that investors in the markets had to quickly unwind a significant amount of positions. So yes, it's opportunities like that where active managers who are going to be patient They have a watch list of products or a watch list of stocks or credits that they want to buy. And when these things come down into their territory where they're more than happy to pick it up, they're going to take advantage of those situations. So it was a good opportunity for longer term investors who can take a longer term view to say, okay, this is an opportunity I cannot pass up.
Absolutely. And John, we'll come on to flows later and where you guys have seen opportunity within these very turbulent markets. Georgie, similar sort of question for you. I mean, I mentioned earlier central bank stimulus, which has been key to driving the recovery in asset markets. Is there a benefit here, do you think, for passive investors?
Thanks, Charlie. Yeah, absolutely. I mean, to your point, without a doubt, markets have been driven up with high correlations to central bank balance sheets. But the big difference now is that investors have been forced to take more risk. As pension funds, for example, they can't get income in safe haven assets like treasuries. So what we actually see is investors are moving into areas of the market like high yield investment grade and emerging market debt. And this is the main reason why BlackRock prefers quality as a factor. And we can talk about BlackRock's views in a bit, but quality companies are the ones that have got higher cash balance sheets and they can really ride out storms in the market. Now, the benefit for passive investors, to your question, is that there's so many different options, as I mentioned earlier, when using ETFs. For example, you can tactically rotate quickly into value or into quality factors or into any of the cyclicals when the market's in the repair phase like it is.
Absolutely. And I think here I just want to take a step back and ask you both, where do you see the use of both active and passive strategies in overall portfolio construction? I mean, in your eyes, is it possible that you can blend the two strategies within an overall portfolio? John, I'll...
Yeah, thanks, Charlie. Yes, you absolutely can. There's a couple of things you should probably keep in mind in terms of, what's your portfolio size? How long is your investment view? How willing are you to allow your assets to work for you over time? We have investors who like to be day traders, who like to be tactical, and we do see some of them turning to individual stocks or even some sector ETFs to try to come in, pick a spot to buy, and hopefully get out with a profit. But there's definitely room within a portfolio for both. And the reason I say that is for those who have done some market research between actively managed mutual funds and passive ETFs, we know that in developed markets like the US, taking into account, let's say, the S&P 500, or you look at developed markets, let's say, in Europe, or developed markets like Japan. The history tells us that for managers, active managers, it's hard for them to beat the S&P 500 historically over time. There are certainly managers who can do it because there's 8,000, 9,000 different mutual funds just listed in the US itself. But to be able to create and construct a very good asset allocation, a great portfolio, you can certainly use active management with passive to sort of create the desired results that you would want over time. And there's many different options that you can use. And that's why you guys at the Frag Group, you certainly do your due diligence to make sure you're working with the best of both managers on both sides.
Yeah, absolutely. And John, just continuing with your point about US fund managers, and particularly in the large cap space, so for particularly big blue chip companies where they're looking to deliver excess returns to what the index would return. Why is it that it's so difficult, do you think, for US large cap fund managers to outperform the market? Is it because it's such a well-researched part of the market?
That's certainly one part of it. There are so many analysts covering the S&P 500. There's so much money investing in US stocks. There's patient capital, but there's quick capital now as well. And what I mean by capital, money coming in and out. If you follow the markets a little bit, if you read the newspapers, you've probably heard about computer trading, right? And people, investors, smart investors who are using mathematics and computers to try and take advantage of 2 cents, 3 cents, 5 cents here. They come into the market very quick. And when you usually have these discrepancies in prices or inefficiencies, that money comes in so quickly, Charlie, that those opportunities shrink really rapidly. So yes, it is because these companies are well researched. The information flow is public. There's no means for insider information, and everyone's trying to react off the same type of information that's coming. They're also trying to use their, as you mentioned at the opening, their qualitative and quantitative methodology to identify these. So what we've noticed is that mutual funds, active mutual funds who are benchmark huggers, they're really going to have a hard time outperforming the S&P 500. Portfolio managers who are benchmark agnostic, which means that they don't have to follow the index one for one. They can sway from the index quite a bit. That's where we're starting to see these managers outperform, because they can use a little bit more of their capabilities and their experience to move away from this benchmark to try to achieve that 300 to 500 basis points outperformance over time versus the index.
Fantastic. Thanks, John. And Georgie, same question to you, really. I mean, your view, I appreciate that BlackRock operate both active and passive strategies, but what's your take on the overall portfolio construction and whether you can blend the two strategies as part of an overall diversified portfolio?
Thanks, Charlie. I mean, I know that everyone's come here for an active versus passive debate, but I think John and I are going to be on the same page when it comes to actually being able to blend the two together. And as you said, I come from BlackRock, which is an asset management company that has both active and passive products. And that's because we do firmly believe that in order to build an efficient portfolio, you really need to blend complementary sources of returns, which means having both active and passive in your portfolio. I know it sounds cliche, but something that we say in the ETF business is that every decision an investor takes is an active decision. So deciding whether to buy that stock, or deciding whether to sell that bond, or deciding whether to sit in cash or have an ETF or have an active fund, these are all active decisions. So deciding when to use an active fund and when to use a passive fund, I guess, is more important. And sort of tying up with what John said about the US large cap market, I'm sure this is a stat that's been heard before, but over the last 10 years, 85% of US large cap funds actually underperformed the S&P 500. Now, as John said, and what you were talking to, Charlie, as well, the broad US large cap market is renowned for being very difficult to outperform for the various reasons we discussed. So here it would make sense to use an ETF or an index fund for this kind of exposure. But what we see is that investors are becoming more and more cost conscious and much more selective when it comes to deciding which alpha generating strategies or active strategies that they're actually willing to pay a premium for. So what we see is that they're still happy to pay premiums for active funds as long as they're providing idiosyncratic risk and returns and, of course, outperformance. If investors aren't getting that, or if they're hugging the benchmark, like John was saying, or hugging a factor, then you could just get that exposure with an ETF at a much lower cost. Now, something else that I want to highlight, I want to add, and is a big mistake that we sometimes see investors doing, is trying to combine too many active funds together. Simply combining the best active funds is not going to get you the best portfolio. I have this analogy that I sometimes use, but although despite being from the UK, I don't follow football. So Charlie, you're probably better to follow than I am. But if you were to build a football team, you don't want to put all of the best strikers from the Premier League in the same football team. It's not going to get you the best team because you need different skills across the pitch. And the same is for your portfolio. Too many active funds is going to result in over diversification of the potential alpha that each of the funds might have been able to produce in isolation. So if all of the active funds are diversifying your portfolio so much that you're just investing in the broad market, then you might as well have used an ETF and paid a fraction of the price for it.
Charlie, let me add something for your participants, just to sort of close this part out. One thing I would ask them, your participants, your clients, to consider when they're looking at actively managed mutual funds. I'll leave them with two things. You want to look for managers that are high conviction managers. And what does that mean? They're going to do research into a whole bunch of companies, but at the end, maybe their portfolio will hold anywhere from 20 to 40 or maybe 20 to 50 stocks. That's high conviction. You want to see them put their money, their money where their mouth is. If they're going to do all this work, make a conviction pick there. And the second thing you want to sort of look at, if you're into doing some fund research on your own, in this market, you want to look for, and to be successful over time, you want to look for managers that have a high active share. I'll explain that. High active share, if you could find something above 50%, 60, 70, 80, the higher you go in terms of the number, that's a higher active share. That means that these managers are not afraid to move away from their index to find interesting names to put in their funds. This is where we're seeing outperformance over time, high conviction funds with high active share.
Yeah, absolutely, John. And it goes to the point that it's looking for those high active fund managers where you can deliver outperformance that I mentioned earlier. So that sort of excess return relative to an index or a benchmark. So no, that's absolutely a good point. And thank you both for your thoughts on that. John, we talked earlier about the opportunities that this year has presented for some sectors. Where are you currently seeing flows? I appreciate we're almost at year end, but we've had plenty of opportunity for people to rotate their portfolios. Where have the biggest flows been that you've seen?
I'll talk about both the flows that I like and the flows that still surprise me. I'll start with what surprises me. With yields so low globally, whether it's government bond yields, whether it's corporate bond yields, the amount of money that clients are still putting into some areas of the fixed income market is a bit concerning for me. And I say that because, yes, it can offer clients some defense. It can reduce volatility. But, if you're investing, Charlie, if you're investing money today and you're thinking about the next 3 to 5 years, and sometimes I meet clients who are thinking about the next 3 to 5 months, but, to be successful, if you're looking at the next 3 to 5 years, you have to sort of look down the road and try to look around the bend. How much more capital gains can you continue to receive from some of these high quality fixed income funds that are delivering you a coupon with yields being so low? So much capital appreciation has already been had. Whereas maybe going forward, some of these areas, clients will not be happy if they're getting income, but they're watching their capital go down. They still want both. They still want some income. They still want capital gains. So I'm still concerned with the amount of money that's coming into some areas within fixed income. We continue to like global high yield. We still think that, what investors are earning from a risk reward point of view makes sense. US high yield is attractive. We continue to like Asia high yield because you are being compensated. In terms of equities, if you're looking at the equity market, we see good opportunities within emerging markets. Some of these emerging market countries are cheap. We continue to like China, Asia for the Asia consumer story, not just across Asia, but especially in China because it's extremely strong. We like the opportunities. I know investors, they do like sector plays. One area that I like a lot, Charlie, and this is not for the next 3 to 5 years, this is going to be for the next 3, 5, 10 and ongoing, is areas within ESG, or to keep it simple, environment. Look at opportunities within climate change, because this is an area that is not going away. The amount of assets that's going to continue to come into these names, that's going to continue to come into this area of the market. We're only at the tip of the iceberg because there's going to be a continuous wave after wave of assets looking for these opportunities and coming into this market. I try to tell my clients that what technology was for the past 10 years, what social media was for the past 10 years, it's been a great place to be. And I think the next longer term structural trend is certainly within climate change, renewable energy, anything along those lines. And first and last, just stay with quality. Just find good quality companies that have strong management teams, strong cash flow. They don't have much leverage. As part of a core portfolio, you cannot go wrong over time, Charlie, with quality companies.
Yeah, absolutely. And certainly that's something we've seen year to date, isn't it? Where, investors have been flocking to those companies which have got strong fundamentals and very strong balance sheets. Georgie, same question for you. Again, I appreciate BlackRock's on both the active and the passive side. From your perspective on the passive side, what have you seen year to date?
Yeah, absolutely. I can talk about the inflows that we've seen with my ETF hat on. Obviously, a lot of clients use our ETF data as a way to sort of gauge broader market sentiment. Now, it is backward looking, so it's everything that's happened and been traded in the past. So I know that John was talking about forward looking, but it gives you an idea of what investors have been doing, especially, and I can talk more recent weeks. But if you look at the headline numbers for the year, fixed income has completely dominated our inflows. We've seen about $86 billion flow into our fixed income ETFs this year versus equity, which only saw about 16 billion. Now, as John said, another real prominent theme that we really cannot ignore is the flow that we've seen into our sustainable products. And we've seen about $30 billion year to date into sustainability. And if you want, Charlie, I can talk about that a bit more later. But as I mentioned, what's probably slightly more interesting is looking at the more granular flow data that we've seen in September. It gives us more of an idea of what's been going on more recently. So within the equity space, we've seen a lot of money moving into US large caps and out of US small caps. Within the global sectors, so to no surprise, technology's really recovered from the sell-off that we saw earlier in late August to early September. And we've really seen a continuation into sectors like materials, industrials, and real estate. On the fixed income side, there was actually quite relatively small flow in September, but what we did see was a shift out of credit and into US rates. And one final point that I want to make is on emerging market debt, where we saw large inflows, especially as China remains a bright spot. I know John just mentioned China, but I think that there's going to be a continuation of the trend into Chinese debt.
Yeah, absolutely. And particularly in a low interest rate environment where investors are looking for additional yield, as John, you've said. Now, I want to move the conversation on a little bit to what we're seeing in the industry and in the asset management industry, because a few active fund houses have started offering their own passive solutions. John, question for you. Do you think this is a trend that's likely to continue?
Just to be straightforward, yes, I think it will. Georgina could share a little bit more on this, but the active managers, the active mutual fund managers who are getting into the passive side of the business, they're enhancing what passive usually means. They're actually becoming active passive managers, trying to add a little bit more outperformance, trying not to necessarily just lag the index, maybe try and meet the index, or even maybe try and get a little bit above it. So our industry is always changing. Our industry is always trying to figure out, what's best for clients going forward. What can we do to improve our services, our capabilities, to sort of be that reliable source for clients? But yes, I think you will continue to see active managers look to maybe dip their toes within the passive side, because let's be honest, there's a significant amount of assets out there, and there's plenty of assets for everyone. But you have to try and figure out your particular strategy for your firm. And yeah, so I think there will be, you'll see more of this.
Yeah, absolutely. And Georgie, are you of a similar sort of thought process that we will continue to see that amongst the active houses?
Of course. So ETF and index investments have been around for quite a while, but it's only really in the last sort of 10 to 15 years that we've seen serious growth in the ETF market. I think it's grown about 10 times from around 750 billion in 2009 to the near 6 trillion that it is today. Now, what we actually saw after the financial crisis in 2009 was that a lot of investors realized they needed to reassess their investment approach. And then what we saw over the next sort of 10 years was money flowing out of active mutual funds and into ETFs. We saw about $1 trillion, just under $1 trillion move from active mutual funds into ETFs. Now there's 4 real key trends that we see that are going to carry this growth forward. The first is, as I mentioned, investors being active in their portfolio decisions. So every decision that they make is active, and that will include using ETFs in their portfolio. The second is investors are becoming much more cost sensitive. They want to have lower cost products in their portfolio. The third is that there's a bit of a shift that we're seeing globally in terms of the wealth management fee model. So it's moving away from commission-based model to a flat fee or fee-based advice model. We've seen that in the US, we've seen it in Europe, and it's sure going to come to Asia at some point. And the fourth and final thing is slightly more technical, but it's about the way that bonds trade. So the fixed income market is typically very opaque. It's very difficult to get prices on bonds. But because ETFs, as I said, are traded on stock exchanges, you can get the price of those underlying bonds really transparently, and they can be traded pretty quickly as well. So that's obviously the trends for the ETF industry. But I think the main trend from a product standpoint is going to be in the innovation. So innovation in the product development. So what we're seeing is investors are looking for thematic ideas, things like robotics or 5G or climate change, to what John was talking about. These are the areas that investors are really care about, and they're really passionate about them, and they want to make sure that that's where their money is. So moving away slightly from the vanilla traditional benchmarks like the FTSE 100 or the S&P 500 and moving into these slightly more thematic ideas.
Yeah, absolutely. Yeah, it's certainly expanding year by year the range of passive strategies available to investors. John, I wanted to touch on something Georgie just mentioned, which is the red inflows, and it's something that I showed earlier that you're seeing within the passive space. Now, I'm going to ask you about media scrutiny of star fund managers here, and whether that's partly the reason why you see some of the flows leaving active strategies and moving into passive strategies. Do you think it's that sort of media scrutiny which raises the awareness of some of the underperformance of these star fund managers?
A little bit. You know, we know how the media works, right? The media likes to take someone who was not well known. They love to build them up into this hero status. Of course, that's going to come along with this particular manager having strong returns, and maybe they're seeing a significant amount of assets come into his or her portfolio or fund. But just as quickly as the media likes to build them up, they love to take them down just as fast. And they're pretty easy targets because, you know, over time they received all this fame and recognition and fortunes. So they become easy targets because they're well-known names, right, globally. And that's going to continue to happen from time to time. It's just the nature of the beast. But, you know, you look at how many fund groups or how many fund families, you know, continue to do extremely well without necessarily being a name that clients will, like a household name that clients will recognize. You know, when people said, you know, when we changed our name to 91, or people see 91, they're going to have no idea what it is, right? And unless they do a little bit more research. But, you know, to be around since 1991, and for some of these other fund groups to be around as long as they have. Fund families, fund groups, Charlie, they're trying to get away from star managers. You know, everything that we do, we want to promote teams. We want to promote a team effort. You know, we have a team of portfolio managers, as you said in your introduction, because you can live and die by one star manager. And even though you can have 100 different funds in your fund family, if you have one star manager who does something wrong, he or she can take down the other 99 funds within that family. So yes, you know, it does come down to media scrutiny, and this is going to probably continue to happen. But thankfully, there's so many choices within the market for clients to look at. And again, that's why they rely on yourself and your colleagues to help them identify through your due diligence, you know, fund companies that you think that they should be working with. But yes, to answer your question, it's going to continue to happen. And it's not just within the asset management industry, it's across any industry.
Yeah, absolutely. And I think it's worth saying that there is some interesting research about how teams of fund managers have over the longer term actually outperformed, say, those star fund managers.
Yeah, absolutely.
Obviously, there's the person risk there.
Because you know what, the team approach, it keeps everyone level.
Yeah, absolutely.
You know, when you have a star manager, Charlie, they fall in love with their positions. They fall in love with them. Management's going to tell them, what do you think about this? What do you think about that? They're going to say, no, don't tell me what to do. And before you know it, you know, maybe they held on a little bit too long.
Absolutely, yeah. So it's trying to guard against those sort of behavioral biases that you can see amongst staff fund managers.
Fall in love with your family. Don't fall in love with a stock.
That's it, exactly. Lesson for us all. John, I'm going to stick with you, and I'm just going to ask you about the amount of flows we've seen coming from retail investors. Again, that's something that the media has focused on a little bit so far this year. What sort of impact do you think that's having on markets as we stand here today? You know, do you think that's sort of altering the impact of markets? Is it creating a sort of distortion effect, or how do you see that?
Not a distortion. You know, the likes of Robinhood, these apps that allow small retail investors to come in and trade the markets. You know, we know, you know, on our side with Georgina being BlackRock, myself with 91, you know, the true money, Charlie, the big money comes from the institutional investors, the sovereign wealth funds. These small Robinhood investors, it's a great thing. I'm glad these apps are out there. It allows everyday investors to hopefully start to put a little bit money away in terms of if they're doing it appropriately. What I don't like about some of these apps is when they don't charge any trading fees. They don't charge any commissions. And I've been around long enough, Charlie, that without trading commissions, without them paying for a trade, you can trade your portfolio all the way down to zero before you know it, because you think, I could just come in and trade this away. But what I've seen, you know, what's been getting the headlines with regards to some of these apps is they're trading in companies that we would never touch. You know, they're trading in companies that they're announcing that they're going bankrupt. The stock is still trading, and these guys are trying to come in there, take their small little fortune and try and increase it overnight by 1,000, 2,000%. You know, they'll trade around some of these other names, but they're really not going to have an impact in terms of creating any market inefficiencies, because it is a large pool of money, but I don't think it's large enough to move markets per se.
Thanks, John. And Georgie, same question for you. Again, those retail flows, what are you seeing in your eyes?
Resonating what John's saying, there hasn't really been a huge impact of retail money on ETF flows, but certainly with the US-China trade tensions, there's been much less foreign investment money flowing into Asian equities. If you look at equity markets like Korea and China, it's these markets that have actually been driven up because retail investors have been buying their domestic market. But if you look at the US, specifically in March and April, and if we look at numbers around the creation of Robinhood accounts, similar to what John was talking about, and the amount of option activity in single lots, if you look at that, the sizes are very small. So they're evidently coming from retail investors, but mostly they're impacting single line equities that were just very high risk. So to sum up in terms of actual effect on the market, there's been more effect in Asia than there has in the US.
Absolutely. I'm just going to add to what Georgina said. Where you do see inefficiencies because of retail investors is the onshore China A-share market. That market is predominantly driven by the retail investor in China. And when they start to buy, they use as much leverage as they can to get as much exposure. They borrow assets. And when things turn around, you have a lot of people trying to get out a small little exit door. But that's where it creates opportunities for the patient investor. So good point, Georgina.
Fantastic. Thank you both. We're very interesting indeed. Now, look, this is the $1 million question I'm going to ask you both, but we're getting towards the end of the main discussion. So I just wanted to ask your views, both of your views, on the outlook for investment markets over the next 1 and 3 years. Obviously, we've got a number of key events coming up by the time this year ends. We see out this year, namely the US elections in a couple of weeks' time. And then obviously whether we reach an agreement with the EU on trade arrangements coming from a UK perspective there. What are your outlooks for the next 1 to 3 years? Now, I appreciate this point. It's very difficult. You know, who could have predicted COVID 8 months ago? No one. But just as a sort of broad outline, what are you guys thinking over the next 1 to 3 years? And Georgie, we'll start with you on that one.
Yeah, absolutely, Charlie. This is obviously a question that we get from clients a lot. BlackRock's actually in the process of coming up with our 2021 views at the moment, and so these should be out within the next month or so. So if you go online, you can probably find those. You mentioned the US election. I think there's a few things that stand Trump and Biden apart. domestic policy being one. So if we look at Trump's domestic policy approach, he's really focused on absolute growth figures, and he's likely going to continue on this path in a second term with things like corporate tax cuts to encourage job growth and things like that. Whereas if you look at Biden, he's also got a relatively large fiscal plan, but he's proposed infrastructure and climate spending with a real focus on improving infrastructure to deal with the accelerating sustainability crisis. On their foreign policy, a Biden win might mean a return to a more predictable US approach to foreign policy and trade. But in the event of a Trump win, I think we're really going to see him doubling down on the America First stance on trade and immigration, as he has obviously done in the past. Now, one thing that's really important, I think, that's going to come out of this election is in the energy and sustainability sector, because a Trump victory is really going to mean a continuation of the status quo in terms of both energy policy and climate change. But a win for Biden, who's evidently put sustainability at the very center of his campaign, that's going to signal quite meaningful change. So taking all of this into consideration, BlackRock are actually neutral on US equities. We really believe that the risks of fading fiscal stimulus and an extended epidemic could threaten to derail the market's strong run. Also, as we mentioned, the US-China trade tensions and this divisive election are really going to weigh on the asset class. Further looking on our sort of 1 year basis, look at it coming into the end of the year and into the beginning of 2021, in the European equity space, we're overweight. We think that the region is exposed to a lot of upside as the economy restarts. And then sort of looping around to what John, I don't know if you heard him talking about quality earlier, BlackRock are really have a very strong overweight on quality as well. We really see it as the most resilient exposure against a range of outcomes in terms of developments in the pandemic and the economy. So that's very, very important. When it comes to fixed income, I actually, before I came onto this panel, I was just reading an email from our sort of CIO team that said that we're moving US treasuries to underweight given the risks of the elections. So that's going to be announced on Monday. So you're all the first to hear that one. And we're also overweight European government bonds, despite some of the recent outperformance we've seen there. And then we've actually also increased our overweight on high yield, because we believe that high yield remains an attractive source of income in what we're seeing as a very yield-starved world. Just quickly on the 3-year horizon, it's a little tricky because BlackRock actually doesn't forecast that far out. But one thing I will say that we're looking at is a higher inflation regime. Inflation is still missing in action after more than a decade of what we've seen from monetary policy stimulus and sort of ever expanding central bank balance sheets. So the question is, why then would inflation become an important investment theme over the next 3 years? And the answer is because there's 3 new forces that we at BlackRock see at play. The first is production costs, which we believe are set to rise globally. The second is central banks are fundamentally changing their policy framework. And the third is that the joint monetary fiscal policy revolution that we're seeing, which is obviously a very necessary response to the COVID-19 shock, but really risks greater political constraints on the ability of central banks to lean against inflation.
As always, the policymakers seem to have all eyes on them. John, same question to you, please. Where are you sort of seeing the next 1 to 3 years?
Yeah, Charlie, I'll keep it short so we can get to the Q&As. Short term, we have to continue to expect volatility, as we move up to the elections and, with the hope of a vaccine sometime in maybe 2021. But if I was sort of looking out 1 to 3 years, where would I be looking to allocate now? Again, depending on client situation, I would be looking at inflation and reflation trades. I'd be looking to try and get some natural resources exposure, whether it's going to be maybe gold or gold equities or just a global natural resources type of equity fund. Within developed markets or just global equities, again, just keep it simple. Find a good global equity fund that concentrates on quality companies. Remember what I said earlier, if you're doing research there, maybe try to look for active managers that have high conviction as well as high active share. but make sure it's still within quality. I still don't think you can go wrong longer term investing in Asia, and especially trying to get exposure to Hong Kong exposure into China or China A shares. Expect some volatility there, but still over the long term, I think you will certainly be rewarded. I do like what Georgina said earlier. If you're trying to get a little bit of defense, you still want to try and get some yield pickup. Look at China bonds or look at high yield bonds in Asia, but make sure you just have the appropriate weighting within your portfolio. And again, try your best to find a manager who can give you exposure to climate change, renewable energy, because they're going to continue to get inflows, Charlie.
Fantastic, thank you. Now, you've both mentioned technology so far this presentation. I'm just going to bring my screen back and move to the Q&A. So we're on to the Q&A. We've had some great questions come through, so thank you very much for that. John, I'm going to ask you the first one, which has come from one client we have here in Asia. Given the natural market volatility, how far ahead of the passive benchmark, or over what time period, is needed for the individual investor to know that they are a small minority that should continue to use active strategies? So I guess this goes to the long-term time horizon, doesn't it?
Repeat that again, Charlie, one more time.
Yeah, so just given the natural market volatility that we've seen this year, how far ahead of the passive benchmark, or over what time period, is needed for the individual investor to know that they are a small minority that should continue to use active strategies?
If I understand that right, well, with the volatility that we've seen this year, this has actually been in general, compared to history, this has actually been a pretty good year for active mutual fund managers. Especially those who are on the high growth side within technology, healthcare, communication, or quality has done well. Value has certainly lagged, but I'm still trying to frame the answer, because I'm still trying to figure out what was actually the question at the end there. But if I'm getting this right, you could stay with passive if you want to get sort of as close to the index returns as you can. If you're looking at active, keep in mind that if you look at most active mutual fund managers, their goal, Charlie, is to outperform their underlying index by 300 to 500, 3 to 5% over a 3 to 5 year time frame. So depending on how much assets you have, depending on the size of your portfolio, I would probably say, if you're on the smaller side, you probably want to look a little bit more on the passive side, as you just want to continue to grow that portfolio. Be committed to allocating some of your salary or some assets into this fund, into this portfolio on a monthly or quarterly basis. As you start to come up in size a little bit, that's when you can start to look at active managers. But if you're starting with a small amount, Charlie, I'd probably say start with passive and let that grow, and then start to look at active.
Fantastic. Thanks, John.
I'm not sure if that answered the question, but.
Yeah, look, for me, I think it's about having a long-term time horizon, isn't it? When you're buying an active strategy, you're buying a manager that is looking to outperform that index over at least a 3-year period, as you've already alluded to. So I think you have to bear in mind that there can be tendencies amongst investors just to trade off short-term noise, and you have to remain invested and look at the long term. So I think
just remember this. I'll leave one thing for you with the participants. It's time in the market, not timing the market. Just remember that.
Yeah. I think that's a great point, John. Georgie, question for you, and I think it's an excellent one. With more investors moving into passive strategies, is there a risk that large redemptions from big institutional clients could exacerbate price movements?
I laugh because this is a question that we get quite a lot. I think somebody must have been reading too much skeptical media. I think that obviously some skeptics believe that ETFs are starting to impact security price and price discovery, although index funds and ETFs actually account for about 12% of global equity assets, which is very small. They actually only account for about even 5%, around 5% of total market turnover, which is even smaller. If you look at the active space, it's much higher in terms of the overall market share. And this is because ETFs typically only trade when indices are rebalanced. So they don't trade that often. So that means that, say, for every $1 that's traded by an equity index fund, I think at least $20 are traded by other types of investors. So you can clearly see that from both an assets under management point of view and from a trading point of view, that non-index investors, as I said, by far outnumber ETFs and index funds, which are so much smaller in terms of the whole market cap of the global, in terms of the global market cap, and therefore ETFs and index really remain. Therefore, that active and non-index investors really remain the main drivers of price discovery. In terms of liquidity, I can use fixed income as an example, as that's really an asset class where, as I mentioned earlier on today, that's quite an opaque market. But what we've seen in the ETF space in times of stress is that when the online bond volumes dry up and spreads widens and clients can't get pricing on bonds, investors naturally gravitate to bond ETFs. And that's because ETFs can offer the pricing on the exchange and you can see it there and then. And that's what we saw in the first quarter of this year when investment grade and high yield ETFs, their volumes were really double what we saw in 2019. So ETFs, what we actually see, they act as shock absorbers in fixed income markets and create additional liquidity through not only the secondary market where they're traded on exchange, but also because, I'm not going to go into too much detail, but because ultimately we can just create more units in the primary market and expand the fund if we need to.
Absolutely. That's interesting. And John, look, this is something that I know we've touched upon briefly earlier in the conversation, but some might suggest, well, one question here is some might suggest part active, part passive. Under what conditions would this be better than going one direction or the other, i.e. using pure passive or pure active? And we've talked about a blended strategy. In what situations do you think this is the most appropriate?
I think in periods, okay, so let's take it down to markets, right? Not necessarily periods, because even within periods, different markets are going to have different reactions to what's going on from policies. But I think if I had to keep it simple, if I'm looking to get exposure to certain sectors, if I'm looking to get exposure to climate change, if I'm looking to get exposure to emerging markets or single country emerging market exposure, hand on my heart, I would absolutely say look at active. Active managers should be able to exploit some of the inefficiencies there. And nothing against passive ETFs, but the underlying index of some of these passive ETFs, it takes them a while to catch up to actually what's going on in the new economy. So, the new economy can continue to move before the underlying index for that country, for that region, catches up to that new economy. Whereas active managers will be able to be out in front of that. If you're just trying to take simple exposure, you don't want to deal with the emerging markets, you just like the safety, the ability to sleep at night, knowing that you have US equities, maybe UK developed markets, and you're happy with dividends coming in, take with passive. But as we see volatility, you definitely want a little bit of both, because one thing you have to understand nowadays about mutual funds is that they're very creative now. You can have absolute return funds who are trying to deliver positive returns over a 3-year period, regardless of market volatility. I don't want to get too technical because there's many different ways investors can look to structure their portfolio. But in all honesty, if you just want to keep it simple, developed markets, take passive. If you want to dabble and get a little bit more exposure into emerging markets, where you probably should, because that's where growth is going to continue to come from, take active.
Yeah, that's great. And I think that's an interesting point on which to end, because we're getting to the hour now, and we've had some great questions. And apologies to those of you whose questions I couldn't answer. We've had some great questions, and so again, thank you for those, and apologies to those of you whose questions I couldn't answer. I think we're now at the stage where I'm just going to wrap up. And from the Fry Group's perspective, we absolutely believe that there is a place for both active and passive managers. And indeed, we include a blended strategy within our own portfolios. As John's already alluded to, I think active managers with a proven track record over at least a 3-year business cycle should be considered where there are the opportunities to outperform. But you can also use passive strategies for more tactical exposure and also for looking to sort of dampen the overall cost of portfolios. But behind everything, when you're managing portfolios, the key is to have a robust risk management and research process. And that's what we're here for, and to help guide you with your portfolio constructions. So just a little bit now about the Fry Group, who we are and what we do. I appreciate that a number of you will already be very familiar with what we do. But we are a global financial planning business with over 120 years of helping our clients across the globe and across the generations. We have three main areas of expertise, which are tax, financial planning, which includes investments, and estates and wills. And at the core of what we do is to provide our clients with financial freedom. Now, we understand that that means different things to different people. So we absolutely take the time to understand what that means to you before structuring a plan around it. So really, that just leaves me to say thank you everyone for attending today's webinar. Thank you, John. Thank you, Georgie. It's been really great to have your insights, and appreciate you taking time out to give us those. As I say, thank you to everyone on the webinar for joining, and thank you for all the questions we've had. I'm very sorry if we haven't managed to get to your question, but if you do have any questions, please do use the contact details, which you should now see in front of you, or contact your local representative. But in the meantime, thank you again, and we hope to hear from you all very soon. Thank you.
Thanks, Charlie. Thanks, Georgina. Hope everyone stays safe. Stay safe.
Thank you.
Thank you.